Hey everybody, welcome to your favorite day of the week. No, I'm not, or of the month. No, I'm not talking about Friday afternoon. No, I'm not talking about Saturday. It is the Bitwave monthly webinar where we talk about all things Bitwave monthly webinar related: crypto, tax, accounting, DeFi, other crazy things that are going on in the world. We even spent a lot of time on inflation last time, which will, I don't know, we're going to avoid that this time, but we might talk about Tesla a little bit today. That'll be our current event topic for the day, is going to be Tesla. So as always, we're going to give people a few minutes to join here, just a couple of minutes. Today we are talking about impairment. So this should be a really interesting discussion. It is about, I always sort of said it is kind of an esoteric part of accounting. Like, I had done accounting for a very long time before I'd ever really had to actually execute impairment. It's just not something you do a lot. Like, if you're doing public accounting or for a big public company, you probably run into this. But like, if you're doing more bookkeeping for small businesses, impairment is not something that comes up a lot. So I don't know if esoteric is exactly the right term, but it is certainly a lesser used discipline within the space. So we're going to be talking about impairment today. It's going to be really, really, really fun. Very excited to have everyone. Spectacular turnout today. Oh my God, so many people. Okay, while we are waiting for people to join up, we'll give everyone like 2 or 3 minutes. We always like to start up with a few things. So first of all, this is not financial advice. This is not tax and accounting advice. If anything that we say during this piques your interest, please run it by your financial advisors, your tax professionals, your CPAs, lawyers, anybody that you need to. Everything in crypto is in the state right now where we're all trying to figure it out. So please run this by your financial CPA advisors, tax advisors, all that kind of stuff. While everyone is joining, we're going to throw up a quick poll. Okay, so we need, wait, Julian, can we do a quick change to add, I've never done impairment for my digital assets? Is that possible, or this is all locked and loaded?
We're locked and loaded.
Oh, all right.
I messed this one up.
If you do not do impairment for your digital assets, I guess just leave it empty here. So we know how many total people we have here. We'll see how many people fill out the form, and we'll kind of we'll tell you an approximate number there. So if you don't do impairment here for your digital assets, just don't fill out the poll. But if you do impairment, put in here how often you are testing your digital assets for impairment. So if you're just doing it once at the end of a month or a quarter, you'll be once. If you do it a couple of times, do it twice. And if you are doing, daily impairment or something like that, then do 3 or more times a reporting period. We'll give everyone a couple of minutes to give like 1 more minute, and then we're going to dive right into this from this. So just waiting for everyone to join. Amazing turnout today. We have a lot of people here for a discussion of a relatively esoteric accounting treatment. That's just amazing. I just freaking love it, everybody. Okay, Julian, let's show the results, and then let's get started here. Let's get this party rolling, as I like to say. Okay, so we had 41 total respondents, which is about like less than half of the people that are here right now. So we're going to say that half the people here are not doing impairment. Of those, the vast majority are doing a single impairment during the reporting period. That's kind of what you'd expect if you're doing this by hand. Now, I don't know if this, this wasn't a super detailed question, but like if you're calculating this by hand, once a period is quite enough to be an enjoyable experience. And then if you're doing it through a tool, that about 20% of those people, so 20% of 50%, which is what's that, 5% of the overall audience, does it 3 or more times. That probably lines up with about, the people that are 5 to 10% people that are using the tool to do this, like Bitwave, because we do that daily impairment testing. So just to give those numbers again, about 10% of the people said 3 or more times. No one said twice. Okay, and then about just under half the total people said once a period, and then everyone else we're going to say is not doing impairment. So All right. My name is Pat White. I'm the CEO of Bitwave. Amazing to be here today. I actually am just I get to start the webinar, and I'm going to kind of bookend it, and I'll add color commentary overall, but I'm actually not going to be the one presenting today. So today we have two folks from the Bitwave team that are presenting. So first, Ori Phillips, who's our VP of Product and Solutions, who is I'm sure most people on this call have probably met Ori if you know Bitwave, because he is on every call helping people implement and getting their instances running and answering questions. So Ori will be getting into the practical side of impairment, like what it means to actually do this. Like, how do you do impairment, especially like with Bitwave and kind of with this tooling. So that's Ori's take on this. And Joe Dillon is a manager on the product solutions team. And he is our CPA. He's our resident CPA on the call and one of our CPAs here at Bitwave. And Joe will be taking over the first part of this call to talk a little bit about the theory here. So this is, I'll tell you, like, I'm excited for this part because, like, I didn't get impairment. It took me a long time to get impairment. Like, when the first time someone said it to me, I had such a mentality of tax that I'm like, why would you lower cost basis? That makes no sense. Like this, like, why would you help someone to have bigger gains and like all this stuff? None of this made any sense. And so Joe's gonna be giving us some of the insight into the overall the theory behind here. So Joe's going to kick us off with why digital assets are treated as intangible assets. We're then going to get into impairment, how you do it, what are some of the common challenges, best practices, and we'll leave time at the end for a Q&A. If you have any questions during this, please don't hesitate to just drop them in the chat. Last time we had the most amazing chat going on. It was so fun. It was like an episode of Cheers in there. So feel free to drop any questions as you're going through, say hi to your friends, whatever you need to do in the chat here. So without further ado, I'm going to kick it over to Joe. Joe, current event talk. Real talk with Pat and Joe.
Sure. Yeah. So you've probably, well, if you pay attention to the news in the space, you may have seen Tesla dumped all their Bitcoin, or like 75% of it. It made big news in Bitcoin and crypto circles. But my real accounting nerds in the room may have also noticed that there's this other little wrinkle to the story, which is not only did they sell their Bitcoin, they had a gain on it, but they also are going to end up taking this huge impairment loss on their Bitcoin. So on their, on their financials, on their reporting, there's going to be this huge, 460 million. It's a huge number. I think the total amount of the Bitcoin that they sold was something like 900 million. So, I mean, we are talking an absolutely material amount. And it sort of speaks to kind of part of the struggle, I think, in the digital asset space as it relates to the constant struggle that we do, which is applying old rules, old accounting rules, old GAAP, old IFRS, to a completely new space. And a lot of times it feels like kind of square peg, round hole. And so, yeah, Tesla, $460 million in impairment.
And I think when the article said that they ended up with a realized gain of about 75 million, something like that. So it is really interesting. Now, some of the stuff that we can kind of get into on the esoterics here is like, once you have that 460 mil impairment expense on your books, I am curious if there's like things that you can do to carry it forward, or if there's any sort of like offsetting transaction, or if it really is just like you have this one quarter blemish that everyone kind of just sort of shrugs and says, oh, it doesn't really matter because it was a weird esoteric accounting rule. Maybe it gets footnoted. I mean, that's something that hopefully we talk about over the next 20 minutes here.
Yeah, no, it's a great point. And I think, well, yeah, I'll touch on that in a minute. I think, well, we can touch on it now. Really, this is something, if anyone followed like MicroStrategies, I think it was their 2020 financial statements, they went like a non-GAAP approach to impairment, which was to allow the recovery of impairment. And they included this whole, essentially they wrote like a memo about it, essentially saying, the way we apply impairment to digital assets doesn't make sense. And it's the exact reason you just said, Pat. So for this one quarter, you just have this $460 million hole on your income statement because of impairment. And I think, Michael Saylor, MicroStrategies' point was, this violates the tenet of accounting of consistency. It doesn't do anything to normalize earnings. It leads to great inconsistency in reporting, and ultimately makes less useful information for users of finance.
For someone looking at that report.
Yeah, and now the SEC, I think, responded to that and said, "Too bad,
Yeah.
we don't like it." Follow.
Yeah, maybe not.
Yeah.
All
So
right, we'll get us into it, Joe, and just tell me when you want me to advance the slides, buddy.
Sure. Yeah. And I mean, just to kind of level set, the reason why we're talking impairment with digital assets is because, the accounting rules that, IFRS, FASB, they say intangible assets have to be tested for impairment, essentially meaning, if the value of an indefinite life intangible asset falls below, its cost basis, you're supposed to book some loss and write down the value of that. And the idea is, to give more quality information to users of your financial statements. If you have something on your books that used to be worth a lot and now it's not, what the rules say is like, hey, write it down so it's more reflective of its true value. But, folks that come from maybe a more traditional, like accounting or auditing background, like I got to think like way back a decade ago when I was a financial statement auditor, usually we just talked about impairment, like as it relates to goodwill, right? And goodwill is like such a, it's almost, I almost want to call it like a stagnant thing, right? We would do, an impairment test for goodwill once a year, kind of just move on. Well, with digital assets testing for impairment, it's obviously a much different situation. If you follow the digital asset space at all, it is not stagnant. It is always moving. It is super complicated. It moves, a million miles an hour, but we still have to apply sort of these old impairment, rules to it because they're considered intangible assets. And so why are digital assets, considered intangible assets? I go back, I think it was the AICPA put out like an accounting and auditing guide. I think it was like 2014, maybe one of the first things I read about like how to apply accounting and auditing principles to digital assets. And they kind of just like run through, we get to intangible assets almost by process of elimination. It's like they consider all these other categories. Is it cash and equivalents? It's like, well, no, it's not legal tender. Is it a financial instrument? It's like, well, no, it doesn't represent actually like ownership interest in an entity. It's like, well, is it inventory? It's like, no. Is it investment? It's like, no. So like you sort of like work down the list and you end up with like the remaining bucket, which is like, well, what is it? Well, it's an asset. What's the life of it? Well, it's indefinite. It's not tangible. So we end up with an indefinite life intangible asset. And then that means all the rules that follow. So if you follow like ASC 350, which covers these things, like all of that applies. And that's kind of how why we are where we are now with it. We can move. Yeah. And this is mostly, the law can't keep up with new tech, right? This is really sort of a function of the regulatory environment we're in, and sort of like lack of, quality rules and regulations. I think, FASB has said like very recently, like look, they're going to be putting out something on digital assets, but for the most part now we are still applying old traditional rules to this category. If folks have followed, the Lummis-Gillibrand bill that, they came out, there are some rules likely coming in the future years, but if you know how government works, it'll probably be years before we get true regulation there. So for the time being, we're, even if it feels square peg, round hole, we are applying these rules. And as I mentioned, from the FASB, the United States GAAP side of things, it is ASC 350, which covers intangibles and impairment and all that. So that's,
and even with like, even if there are changes, I'd be pretty surprised if, impairment ever went away altogether from FASB. Like I could imagine a world where some of the tier 1 tokens, Bitcoin, Ethereum, like, kind of give it a name, end up with a more sensible treatment. But, if you're trading some, really, really long tail asset, it's hard to imagine they're ever going to be like, yeah, that's an investment grade, investment grade security that you should be treating that way. So, even with sort of the murmurings that FASB is going to be talking about this, it really would surprise me, if this goes away entirely. Now, I've been surprised before, but I'd be pretty surprised if it went away entirely.
Yeah, I think you're right. And I think we're going to still end up in a situation where we're not going to get a one size fits all, like, right, a blanket policy. I think it's going to come down to how they categorize a lot of these things. What's a security? What's a commodity? All that. And we'll still be having a lot of these conversations. Good for us accountants in the room, because there will most definitely be a need to help sort these things out. We can go to the next one, Pat. So how is impairment, how's it currently recorded? And what are some of the challenges? We started with that poll of how often do you test for impairment? And like I said, back in my, financial statement auditing days, we used to test goodwill once a year, because that's what the standards say, right? They say at least once per period, you have to test it. So if your reporting period is annually, well, that means, okay, at least every year, but like, what's the right number? What's the right frequency? What is most accurate? What gives a better picture of your asset's actual value? There's a lot of considerations there. And, I think that along with those challenges is the nature of digital assets themselves. I mean, simply capturing the data itself is really difficult. I mean, that's a huge part of what we try to do here at Bitwave, is just capturing complete and accurate data. And then from there, every single acquisition becomes a new lot, right? A new lot to track with its own cost basis. And, if we talk about testing impairment on a lot by lot basis, if you are dealing in any sort of volume, you're really, and applying, a strategy like FIFO or specific ID or anything like that. If my favorite people to talk to are folks who have tried to do this in Excel, because then they see the Bitwave solution and they're like, oh my God, finally something, because it's really, really hard. You're talking about thousands and thousands and thousands and thousands of data points to track, that doing manually, it's such a huge burden. You almost need like a fully dedicated person or function for it, which is why it wasn't on our poll question of like, how many of you aren't doing this? We see that quite a bit, right? We see people who have sort of put off testing for impairment until they can find a feasible solution. And that's, part of what we try to offer here. So yeah, we can move, Pat, unless you have a comment there. Yeah. So in theory, if we're picking the cadence of how we test for impairment, you can go, if the least you have to do is once per period, once a year, the most you could do is what, you could test for impairment every hour. You could test every day, every week, every month, every quarter. I think we've seen a lot of people settle into a daily cadence. And then there's still a bunch that kind of maybe do it a little less frequently in monthly or quarterly, intervals. But essentially what we're doing when we say test for impairment, just to be like very clear, what we're talking about is, so whatever window you choose, whether it's daily or quarterly, you're finding the low price for that asset in that window, and you're comparing that price for the asset versus the essentially your carrying value rate of all of the lots in your holdings. And so that means, like, on any given day, when you're testing all your lots versus this low price, all of them might get impaired. One of them could get impaired, 20, 30, any number in between. And this sort of speaks back to the trouble of trying to do this manually. It's not impossible. It's just an insane lift.
Yeah, we've heard that one of the large public companies that holds crypto has basically one person dedicated to just owning their impairment spreadsheet. I mean, there's that much complexity in a spreadsheet like this, because it's recursive from the Excel perspective, that you're having to evaluate a recursion on the carrying value, because multiple impairments can happen that then affect you impair from the previous carrying value. So it's a tricky, to say the least, it is a tricky Excel spreadsheet, I think, is a very fair statement.
Right. And so if we say, if we think about this sort of like 4 steps to this, we're comparing the purchase price, which is going to be, our cost basis of each asset with its market value. And then if at any point in that window, the price drops below, then we're going to consider that asset's impaired. We're going to write down the value of that asset. We're going to book an impairment expense. And, we're just going to keep repeating this over and over and over again. In theory, there's really nothing about intangible asset like impairment testing that's really that complicated. It's just like, look, if the price drops below, then write it down. And like, it's as simple as that. I think what we'll get to is, in reality, we're talking about a lot of these pain points of what this looks like in reality is, and Pat, you can move it forward. I think what happens is that this right here, this is my brain when I tried to do this, because you think about the data points we're tracking every single lot. You also have to track, if you're applying a methodology like FIFO, you're relieving some of those lots. So you have to keep sort of tracking that cost basis, that carrying value for every single lot, every single instance of impairment, forward, forever. And eventually, your desk ends up looking like this, trying to keep track of everything. There are some, I think, Pat, if you go to the next one, like this is a perfect example. This is probably hard to read because of the density of the information there, but this is the life cycle of a single digital asset purchase. It's probably hard to see, but if you look up, this is someone purchased 0.05 ETH in this transaction. And every single row here is something happening that impacts that lot. So you see
this is one single lot. Like this is like our impairment report for one single lot here that you can
and Pat, I had to cut it off because I couldn't get it to fit in an image. But like, this is what can happen. With digital assets, they're like they're divisible in like a never-ending sense. So you can spend 0.00003 of something. So you buy a little bit, and that's your lot. And then we're tracking these dispositions all throughout, and you have to keep testing impairment on that same lot, maintaining the
on the remaining inventory of that lot. Like that's what you can kind of see here as you're going through this, is that we basically start impairing. Smaller and smaller amounts keep getting impaired as the tokens are getting spent. So by the bottom here, you start out with 0.05, but then you're impairing 0.01 here because that's what's actually left in the lot on there. So you're adding this like level of you have to overlay all of the actual inventory tracking and the lot level tracking of the remaining inventory in the lot to get into it. Joe, we got a really good question, which I think it's worth us addressing right now, which is, should impairment be shown separately or netted? So if you bought BTC at 40K, sold it at 25K, do you record the revenue at 25K or 40K, then debit impairment 15K? So this is something that actually super confused me early on also, was this idea of it's a one, like I always think it's a one-way trip. Like going to impairment, carrying value or cost basis into impairment is this one-way trip.
Yeah, this is a great question. And this is actually super topical right now. And we've been talking about this with a bunch of firms, right? Which is, the idea is like, if you bought Bitcoin at 40K and you sold it at 25, well, in theory, what that means is that the price drops down to 25, right? So maybe you haven't tested it for impairment yet in your window, but in reality, that price has dropped down. So some accountants would say, yes, what you should do is you impair that asset, that 40, that has a cost basis of 40,000, impair it down to 25. So it has a carrying value of 25. And then if you sold it for 25, then essentially your net gain on that ends up being 0. I think this is something that I'm really curious to see how widespread this practice is, because we do see, I think, some take a less aggressive impairment approach, I would say, which they just stick to their regular cadence. And if they hadn't impaired this lot, then they would book that gain of 15,000. But I think we're going to be seeing more and more of this. And I think the people who are really sort of thinking about the second level impact of impairment are doing things like this, like impairing it down there, which makes it's like almost hard to, like, almost can't have a realized.
You would never have a realized loss. Is that if you're doing impairment, you should never have a realized loss. But the other side of this is that you never net it with realized gains. So essentially, it is impairment expenses are mutually exclusive with realized gains. So when you take that impairment expense from that 40K down to the 25K, so let's take a slightly more complicated example, which is 40K down to 25 and then sell at 30. you never reverse your impairment expenses in US GAAP. So this is different for IFRS and different accounting standards, but you never reverse your impairment expenses. You are taking the impairment expense, and then any realized gain then hits realized gain as a separate line item. So downwards is always impairment, and then up is a realized gain here. So we got a follow-on question. Did you say digital asset impairment needs to stay at a loss equal to lowest price during its lifetime, or can it be reevaluated upwards? So in US GAAP, well, go ahead, Joe.
Yeah, I mean, you just touched on it really, which is US GAAP, it doesn't allow for the recovery of that impairment expense. And that's what I was mentioning at the beginning that MicroStrategy tried to do before, the SEC slapped their hand. But IFRS actually does allow for the recovery of impairment. So that's where we start to see these, these sort of differences between US and international rules. Can you test impairment using average cost, the digital rather than impairment at the tax lot level?
You can so the way I sort of answer this question, and I'll let Joe also, is that I won't say you can do whatever you want, because impairment was not exactly designed for a world where you have highly liquid markets. And when I say you can do whatever you want, I don't mean you can do whatever you want. I mean, you can do whatever your auditors and advisors are comfortable with you doing. So if there's a world where your auditors are comfortable taking a volume weighted average, it would not be cost average. You have to define some sort of notion of what average cost is. So it would normally be something like volume weighted average, or we have some people that want to use where management has taken a proactive, has made a proactive action. So that would be using pricing from within your overall set of prices that you have ever used for crypto for the period, the lowest of those prices. We have people who use a daily low. We have people who use the daily close. We have people who use the daily VWAP as the impairment price. This is one of those things where you said the question is, can you test impairment using average cost? You can do whatever you want as long as your auditor is comfortable with it, as long as it's gonna pass muster.
Yeah, that's really what it comes down to. I mean, this is the gray area, right? And I think without real software tools, I think this is the type of practice that I think we've seen some people come into Bitwave having previously done something like this, because on that slide where we were showing that single asset lot and how many times it had been touched, it's so hard to do manually. It's just not feasible. So people deferred to things like using an average cost. But what is most accurate, what is most, specific is probably doing it on the lot level. But like Pat said, if you can get your auditor to, sign off on it, then by all means. I think I do want to make one distinction, the use of the word tax lot there, impairment is only applying for what we would consider your accounting records, right? There is no impairment as it relates to your tax reporting. So we often sort of mix terms and call all these lots tax lots, but, I'll try to use the term cost lots so I can be clear, just because, for impairment, it isn't existent in your tax books, which this is one of these places now where with digital assets, you start to have this divergence and a real requirement to kind of have two sets of books. If you come from that, financial statement prep world, you're very familiar with these tax to book adjustments that you have to make. Now, impairment for digital assets becomes one of those.
What I would tend to say, I tend to use the term inventory. You have your accounting coin inventory versus your tax lots, because you then are holding on to these inventory items, which are buckets of disposable items or sellable items that you have to track for impairment in that way. So good. Joe, is this where we kick it over to Ore, or are we still?
I got one. I think I got two more things. All right. One, so best practices. I mean, I just want to touch on it. It's honestly best practices for anything that you're doing from your accounting perspective, from an auditability perspective. I think you want to choose a methodology and essentially stick with it unless you have reason to change, right? The idea of applying a consistent methodology, and by the way, documenting it. So documenting what you're doing and why, that's going to help in you getting your sign off from your auditor, and making it clear what that methodology is. No black box of like, well, we just kind of do this and you can't, having the data available to make it auditable. I do want to touch on this. This is picking an impairment cadence. Pat, I'm going to share my screen here for a second, if it's okay. I just kind of mocked up a super quick demo of where, why this matters from, choosing your cadence. Hold on, if I could find my right tab. So I mocked up this really quick demo to just demonstrate the difference between a daily impairment test versus a monthly. And don't worry, I'm not going to spend a lot of time on here.
No, I love this. This is awesome.
Yeah. So what I've got here, I've got just like a fake data set here with 5 purchases. These are the dates, this happened over the course of January, 5 purchases here, and we've got their acquisition price. And then over here, I've got, the running prices every day. And in these columns C and D, all we wrote in here is like, okay, if you're testing daily, what lots do you impair when? And if you're testing monthly. And as you see, when you test daily, you're testing that daily, in this case, the daily low price. So that's what we have here is we have the low price from every single day. And we're comparing that to the acquisition price over here in column I. So for this first lot, we acquired it at $3,700. Price doesn't dip below it. Price doesn't dip below it. Here it is. Price dips below. We need to impair lot 1. Well, as it keeps going down, we keep impairing lot 1. We keep impairing lot 1. We keep impairing lot 1. Then it goes up. And then I think the second lot comes in on January 10th. So once we have the second lot on January 10th, that's bolded here. Now, every day when we get that low price, we need to be both comparing the lot 1 carrying value and the lot 2 carrying value, because now we've acquired another lot. And we do that. And as you see, as the price goes down, we hit our lots, and that just kind of carries throughout. If we go over to the monthly column, you'll see we're not testing, the lots as they're acquired to the daily price. We're looking at all the lots that we held at the end of the month, which would be all 5 of these. And we're just going to compare it to the monthly low. Well, if we look at this list at the monthly low, we find it here on the 24th of January at 2188. So we're going to hit on this, we're going to hit every single lot at this price that, had a carrying value higher than this price. And if we look at our list, we can tell, that's pretty much everything here. And so I want to, divert your attention to J and K. So here is at the end of the period, if we test daily, here's the carrying value of each lot. It adds up to just under $12,000. If we do it monthly, here's the carrying value of each lot, and it adds up to about $11,000. Now, in this example, that's not, it's $1,000 difference. And, what's the big deal? 8% difference. If anyone remembers that first slide we had up about Tesla, what was their
460 million. So
460 million.
10% of that, 46 million. Is that material?
Yeah, right. We talk materiality, and that's we got this 8% difference over 5 lots. Imagine you're tracking thousands of different assets over thousands of different lots. The cadence at which you test impairment ends up really mattering. And so I show that really just to demonstrate how intentional you want to be and why you want to document that methodology and be consistent with it, because it really can have a material impact. And Pat, we can go back to the slides here now.
So something, do any of your clients impair their digital assets on a monthly basis? We might have 1 or 2 where it's not that big of a deal, so they do it. But the vast majority of our clients do daily impairment. Daily impairment is the way to go on this stuff for sure.
Yep. And
Joe, that was fascinating. We've been meaning to do that. I really want us to do that at scale across our customers, so we can basically show the difference there, because I actually would have expected that it was lower, that it would have been inverted. I would have expected that was inverted, to be super honest. I would have expected that the monthly impairment was actually a higher impairment charge than the daily impairment like that. So that was super, super, super interesting. Thank you.
Yeah. And if anyone, by the way, yeah, I just mocked this up. Some people said like, hey, can I get a copy of that? Sure. That's you get a little sneak preview into my brain.
And then Ken asked a question, why the monthly impairment test use the lowest point? Technically, that is I'd say the truest reading of GAAP for a highly liquid market, which again is kind of wacky. But the truest reading of GAAP is that you should be impairing to the lowest price during the period that you're looking at, the lowest valuation of the price during the period. So that would be why you would use that low instead of one of the higher values.
And that speaks to like, the principle of essentially just being conservative in your treatments. That's really it. Yeah. And anyone who wants a copy of that sheet, feel free to reach out afterwards and we can distribute it.
Oh, by the way, info@bitwave.io and we can get you that stuff.
Yeah, there's a whole nother, we won't spend a lot of time here because this slide in itself could be an hour.
We'll do another webinar all on
Yeah,
this.
we'll do another webinar. I just wanted to raise it for real quick, which is like, we brought in all those prices, we're testing them. We haven't really talked about where those prices came from. There's an entire sort of methodology of determining where those prices come from. Fair valuation. Fair value rules in GAAP, in IFRS say you have to choose a principal market from which to get your prices from. And what that means is the principal market may be different than the market that you're transacting in. So in the case of digital assets, you might be transacting an asset on FTX, but per the accounting rules, really the principal market for, the asset that you're trading is actually Binance. So really you should be using the Binance prices to test for your impairment. And, there's three main considerations, I think, where I would put them. There's a lot more. Like I said, this could be an hour.
It's a long white paper. Yeah.
Yeah. But I think I'll put it in three buckets, which is like, when determining your principal market for where you want to get your prices from, you have to consider, like, you have to have access to that market. So if there's like a geographical reason you can't trade in that market, you wouldn't use that market's prices.
That would be example there would be Binance International. If you are a US company and you cannot legally work with Binance International, you should not be using Binance International for pricing data.
Yep. And then the other is like, the exchange. Some people just like go easy with like the highest volume. Other people say, well, really, you should be looking at the exchange with the highest volume and maybe the deepest, like the most liquidity, essentially like the deepest order book, so that's a consideration that could be made. But then sort of laying over the top of all of this are these other like qualitative factors, like the reliability of the trade data. If you've been in the crypto space, it's not shocking to hear that sometimes all the data and information you get isn't always spot on or perfectly accurate. So just because an exchange says that they have all this trading activity, all this volume for a particular asset, like, did they really? Is that accurate info? How old is that info? Was there a bunch of wash trading and it shouldn't be, it's not real. So there's a bunch of qualitative factors to consider here as well.
This was like, if you followed like a lot of like the Tether drama with Bitfinex, this is a good example of that. There was a lot of allegations that Tether was being minted to do wash trading on Bitfinex. If I were doing an analysis, again, like what I say doesn't matter. What Joe says it don't matter. What matters is what your auditor and what your advisors say. So when you go and you do this analysis, these are things to keep in mind. But like, I would never use Bitfinex as a primary market. I would basically write that down as a non-trustworthy data source. And I would probably do that for Binance too. I mean, Binance is a little bit less there, but like, it's one of those like qualitative things. Like, if a company changes their headquarter location every 6 to 12 months and like has a very ambiguous officer structure, doesn't have mechanisms to report fraud, doesn't adhere to global KYC rules, like, you got to be very careful about using it as a principal market. Now you can, it doesn't mean you shouldn't, but you just want to think through those things there quite a bit.
Yeah, Pat, I want to make one comment, which is, we've said a handful of times, like, it doesn't matter what we say. It matters like what your auditor, what your accountant says. I think I want to make clear, like, that's kind of sort of sums up our approach here at Bitwave, which is like, we we do not give prescriptive guidance. Like, you don't come into Bitwave like, this is the way that Bitwave tells you you have to do your pricing. Our job, I think we view it as to flex accordingly to the treatment that you've decided on. So we aren't going to give you like a perfectly prescriptive answer a lot of times on how to do these things. We're going to refer you back to your auditor or your accountant or whoever.
Yeah, and there are a couple questions. So what rate is the balance according to Bitwave pulling? That is in fact configurable depending on the addition of Bitwave. So the advanced accounting module, we actually let you build rules out for pricing. So you can do asset by asset, date by date pricing from different principal markets. So we have customers that do actually have, for 2021, are using Binance as their principal market for asset 1, 2, and 3, using Coinbase for 3, 4, and 5, and Huobi for other things. That's pretty common. The default that we'll show out of the box, if you don't do anything, is we use the crypto compare volume weighted average. So we've done a lot of analysis. We think that is the best sort of general purpose pricing engine. Most auditors are relatively comfortable with that, especially if you're not going through public audits and things like that. But at the point at which you are looking to go public, you have public auditors, you need to follow US GAAP, you would want to do a principal market analysis and then feed that into rules for our pricing engine. Then we can use different pricing sources for different assets there. Super interesting question. Is asset defined by symbol or contract? So I'll tell you a story about why Do Kwon made an enemy for life from me. I didn't personally lose any money in Terra. There was two things that happened with Terra. One is Bitwave, we launched our Terra integration the week before all the nonsense happened. So he made an enemy of life for me because he made me waste engineering resources. That's step number one. Step number two is that he changed the token name of Luna to Lunk and then launched Luna 2.0 under the symbol Luna. So it's the most obnoxious thing in the entire world. But the way Bitwave works, and this is useful for anyone, any of our customers that are on there, symbols for tokens can change. So like if you were sitting on Luna in your Bitwave instance, after all this happened with Terra, you would actually you would see Lunk listed as the token there because that symbol did change and it was sort of a canonical change of the symbol that everyone agreed to. It's a pain in the ass when it happens because it impacts where we're pulling pricing data from. Not all the exchanges move at the same time. So Coinbase was still using, well, Coinbase never listed this, but like half the exchanges were still using Luna, half of them were using Lunk. I mean, it's the most miraculous disaster. It's just such a pain in the ass. But the way that Bitwave works in particular is that we track the coin itself has an ID that you can get from the export that never changes. So like in Bitwave, Ethereum is 10. The ID for Ethereum is 10. Bitcoin is 1. So that never changes. The symbol could theoretically change over time and stuff like that. So it is tied to, I wouldn't say the contract, I would say the physical representation of the coin then gets priced out. The symbols are fluid. So other symbols that have changed, Luna to Lunk, SNX did a version from SNX to SNX v2. We gave the SNX v2 the canonical SNX and we deprecated the v1. So you do see this from time to time. But sometimes like in that situation where you could do SNX to SNX v2, you could always migrate. So we actually priced them the same for the same token. We actually use the same underlying pricing because they were equivalent tokens because you could do a non-counterparty switch between them. So, whew, all right, that's deep in there. All right,
Ore showed off. Yeah.
Take us away, my friend. You want the screen?
I do.
You got it,
sir.
While you're pulling that up, I'll answer a couple of questions here. Oh, go ahead, man.
All right. So I'm actually going to start from the end part. I joke that Pat and Joe gave me the easy part because, they've said all this hard stuff, all this complex stuff to think about, all these challenges, but impairment in Bitwave is done at the click of a button. Now, there's a bunch of massive, let's call it engineering capital and like accounting capital behind making that happen. But realistically, just to do it, it ends up being a click of a button. So I'm going to start, at the end, and then I'll peel back into the complexities of what's going into it just to show you that piece. So I'm going in the middle a little bit just to show. So it is literally based on, for example, in this case, I've got a start date, I've got the end date. I will go into more detail on tax strategy and all of that. I've got some kind of inventory relief methodology that I'm using, and I am there's some information about, am I capitalizing fees or not, and I am calculating impairment. The click of a button part is literally, I am going to click this button and it's going to run through the processes on the transactions and eventually give me an impairment expense. Now, that was easy, true. There's a bunch of setup and kind of like implementation things that go into that to get you to this point. So that would maybe be my first point is, yes, you can do it at a click of a button in Bitwave, and it'll give you your impairment expense and the required reports here. So there's a actions report, which I'll download. There's a gain loss report, which I'll download and pull up and show later. That gives you lot by lot information, but starting at the end here to come back to the beginning. Click a button, run it. It gives you the numbers, and then there's lots of detail around it. But let me dial back a little bit to talk about kind of what goes into it, and then we'll drill in here. So the first thing I'm going to do is take you to transactions. So ultimately, in this sort of demo instance that we have, we connected a wallet. So for those who are, I know a lot of people are familiar with this, but from a Bitwave perspective, you can literally in a matter of minutes plug in your Ethereum wallet or whatever wallets that you use, and we pull in the transactions that are associated with that wallet with the balances appropriately represented. So that's the step one that goes into the journey of impairment. So in this mocked up instance, we have about 6 transactions. For those who are familiar with Bitwave, you will know that when it's green like this, you see these are deposits coming into the wallet and coming into your inventory versus reds, which are things going out. So in this case, if I'm starting from the bottom, on May 19th, there was a deposit of 0.05 ETH, another deposit on different days going to, these are about 5 deposits. And eventually it looks like, and this is something kind of pretty unique, right? Is there's this action of, it looks like some link coming in and some ETH going out and some ETH going out. Effectively, that is something that's pretty much auto-identified by Bitwave as a trade. So it looks like the owner of this wallet essentially, after depositing a bunch of ETH into the wallet, effectively just did a trade of ETH to link and had a fee associated with it. Now, there is a lot of thinking that Bitwave is doing to put those things together intelligently. That's a discussion for a different webinar, but just giving you a feel of the transaction. So relatively simple, 6 transactions that have happened, deposits and a trade. That's your starting point. Now, all of these are, we talked about pricing earlier. All of these are priced again based on a defined pricing source. So you will have a pricing, probably a memo that says this is our pricing source. And from a Bitwave perspective, we connect to the appropriate pricing source. Again, lots of discussion for another webinar, but here are your transactions. Now, let's go to the journey to sort of impairment. So going to the tax center, so I kind of started from the end previously. The first thing that I think I want to highlight about this is something Joe mentioned earlier, which is we actually are not forcing you into a tax strategy or inventory relief strategy, right? We have a variety of them. So first in, first out, last in, first out, cost averaging, spec ID of different kinds and levels, and we'll show for your inventory relief. And one of the unique things, and we've seen clients use this quite a bit, is you could actually kind of like pick say I'm a first in, first out kind of strategy shop and do all of that for a whole year. And you could actually decide to run as a scenario. What would it all look like if I did last in, first out at the click of a button? So we've actually seen clients do that. I know, from maybe from a pure CPA or a Joe's perspective, you're not necessarily trying to flip every month to say last in, first out this month, first in, first out next month, or that sort of thing. But we've seen clients use this as a scenario thing to actually say, hey, what would it have looked at in that other scenario? Kind of a little bit of what Joe did on the spreadsheet, you can actually do in system at the click of a button for analysis purposes, or if it's even for decision purposes. So running in here, I know that those transactions were in May, and I kind of know the date, so I'm just gonna narrow in on the time period of that those transactions happened. I'm going to plug those in here. I think it ended on the 23rd, but I'll go a little bit further because it'll give you a chance to see impairments actually after those dates. Now, again, I'm picking my sort of inventory or disposal relief strategy here, which is in this case, first in, first out. I will show, because specific identification is something that you can configure separately, I'll give you a glimpse into that. So I click that, I select that, I'm going to run the scenario. While that is going, I'm going to take you somewhere else just to show you here. So there is configurability. If you were using spec ID, right, there is a tremendous amount of configurability here. So if you think about what this is doing here, I can select here, I'm saying I'm doing a short-term loss, I'm maximizing my loss, or you could say I'm going to minimize it, long-term loss, or you can flip any of these where, actually it's actually a short-term gain, minimize, maximize, coming up with a very unique strategy. And there's actually deeper strategies that you can do beneath this. So if you were doing spec ID, there's probably a whole webinar on discussing this and applying this strategy, but just want to show you the configuration behind if you decided to do spec ID here, if your selection was here, which I didn't select. So this is first in, first out. I ran it. It told me, here's my impairment expense. It also told me my realized short-term gain and unrealized as well. The transactions are here, but I'm actually going to jump into, I'm going to download the actions report, which will show lot by lot activity. So we can kind of like spend a little bit of time looking at that. So downloading those. I'm going to pause here real quick. And all right. So actions report. So Joe kind of showed this earlier in the presentation. There are a number of things to notice here. Obviously, the timestamp of the transaction, obviously every single action. So if you had, 200,000 transactions, all of those transactions would be represented here. There's an event happening with each of those transactions. So are you acquiring the asset? Are you disposing of the asset? And then there's these unique things here called that obviously are the impairment actions. So let's take an example. So in our instance, if you remember when we looked at it, we had about 6 acquisitions. This was the first of them that happened on 5/19. That was the acquisition. There was another acquisition on 5/20, and that's the event. These are transaction IDs representing that event. Now,
the event ID would be like the blockchain ID where a transaction happened. So the trades that's the blockchain ID of that trade is. If it was an exchange trade, it would be so it's the event ID is separate from like the lot ID or the inventory ID that we sort of track.
Great call out, Pat. So going to the lot ID, in this case, you can see that the lot ID is, it seems like it, but it's different. So when this event happened, we manufactured or created a new lot for this. Now, there was a second event of another acquisition, which is a new lot. Now, there's some details over here that I'll go through real quickly. Is that first lot was an acquisition of 0.05 ETH at the exchange rate at that time was 1,990, which meant the carrying value was this amount. So that's just this times this. Now, the second lot, though, is was at a different time, which effectively gave you a different exchange rate and therefore a different carrying value. Now, here's the first time you see an impairment action. So I'll make a comment here. So you see that this environment was configured to do daily impairment, impairing to the daily low price. Again, there's a lot of configurability to that. In terms of using, daily close, daily, whatever it is that you want to use. This environment is specifically configured in this way. And so the first impairment action, interestingly, happens on 520, because in fact, if the price on 519, right, is not actually lower than the 1990, there is no impairment action for that day. So the first day that there's an impairment action is on 520, and you can see at 11:59:59 is the 11 right before the end of the days when the impairment action is happening, and effectively the low price of that day was 1956.88. And so we have two lots that exist today, and we need to impair both lots, right? So that's that first lot. You can see that those two match, and that's that second lot. And what we're doing here is saying, this is the new price that we should use, which is obviously the same. This is now the carrying value, and the impairment expense is here. What you would expect, which you'll see, is the sum of this and the impairment expense is 99.54, which matches that carrying value, right? Because we're impairing with this impairment expense, impairing down that carrying value to this, right? And then same here, if you look at this, that is effectively 98.8, which was the carrying value here. So this is your impairment expense. This entire column, right? The sum of this entire column is the impairment expense for that period. Going further, there's a number of other activities that happen. So a few more buys on the 23rd, and then all the disposals. I think something to highlight here is, again, if you think about, we chose a first in, first out strategy. So this first disposal right here, that's the transaction, we would expect to dispose from the first lot, and it does, right? So if you look at the lot that's being affected here, right there, that is because of a first in, first out strategy. We're actually disposing first that lot up here, 0.05, and the price is different. We calculate the fair market value at this moment, and then you have a short-term gain in this case, because the fair market value is 102.93, and then when you take away the carrying value, you're going to get the 5.08. So again,
or I'm going to jump in because I want to make sure we leave a little bit of time for Q&A at the end of this, but hopefully this kind of shows off how this is a good model for, this is like what our impairment report looks like. It's a good model in general for how you want to be thinking about this, because you are doing lot by lot level impairment. You want to see actions on a relatively regular cadence that follow the impairment. This gives you full visibility into all that data. Like having a report like this, whether you're producing it or your auditor is or whoever, gives you a lot of defensibility. Like that report, we've handed a version of that report with millions of lines over to Big Four auditors to do full audits of all of the data. It helps them a lot because they can both do audits of the pricing, because from that you can actually do price auditing, but then audits of the acquisitions, you can do blockchain level pricing, all that kind of stuff. So really, really good. Thank you, Ore. So I'm gonna bring the first question that someone asked, and if there's any other questions, feel free. We've been trying to answer them kind of as we go here. But someone asked the great question of like, what is the benefit of doing impairment? And like, it chuckled because that was the first time I ever saw this, that was my question as well. I was like, why am I doing this? How does this help me? The thing to understand about impairment is it is not designed to help you. It is designed to punish you. And I don't mean that in a mean way, but it is the idea, if you are holding intangible assets on your balance sheet, the notion, I guess the general consensus is that you should be paying a price if those things are going down in value, essentially. Like I wouldn't say it's to dissuade you from holding intangible assets, because that would be a business decision. but it kind of is. Like it is kind of from an accounting or from a US GAAP perspective, it is really trying to dissuade you from holding these things, because impairment is meant to penalize your balance sheet for holding an intangible asset that goes down in value. It is meant to express to people reading a financial statement that you have downside risk exposure to these assets, and it is meant to sort of highlight a risk on your balance sheet. Like it's one of those things, like if you have an indefinite period intangible asset, they do want that to be shown as a risky asset. I think that sort of lines up. Like if you go down, if you think about even the balance sheet from like cash equivalents at the top, intangible assets at the very, very bottom there, it is one of the riskier, from like public accounting perspective, GAAP perspective, is one of the riskier asset classes. So impairment is meant to be a punishment for value changes on those assets. Joe, did I say that right?
Yeah, essentially, yeah. And that this is the idea of conservatism, right? You're reporting the lower number because, you know, there's that risk there.
It is definitely meant to be, punishment's a bit strong, but it is the most conservative treatment, is to assume that for these assets, it's going to go down in value and not back up. So that is sort of how it works. And it is not meant to help you. It is meant to hinder you, but it is helpful because it means that you will pass a US GAAP audit and your auditors will be happy and all that kind of stuff there. Any other questions, Joe? Any other interesting questions? You were rapid fire answering them. So
yeah, no, you know, just to clarify, remember, this is really just about your accounting books, your GAAP requirements, your IFRS requirements. It's not, it ties into what you just said. It's not going to help you on your taxes, unfortunately.
Nope.
No,
and even I guess even on your taxes, right? Because on your taxes, you would take it as a loss. But this does not apply to taxes. So there's no reason to theory.
No, but a ton of great questions today. So thank you, everybody.
Yeah. Other ones, just keep in mind this isn't tax related. I will say, so one question, if we don't have any other questions, Diana, we will get you pricing on that. Someone from the sales team will follow up. So Andrew asked an interesting question, Joe, which you did, which you answered correctly for our context here, but I think is more interesting in general, which is, any thoughts on international tax impact for cryptocurrency sales in foreign countries? This is a super interesting question in general, and we have like 1 or 2 minutes here. We can chit chat about it. To Akeem, yeah, we ran through a full audit with a couple of the big four using our impairment reports. So that's people seem to like it. You know, all you can do is provide as much information as possible, but that's the idea. I don't know, the tax nexus question is super interesting, because I do think that there's some interesting questions around this that have yet to be totally hammered out, especially with things like DEXs and stuff like that. Like if you do an on-chain trade through Uniswap, like if that's, because we do have customers where that's their principal market, like they do all their trading through Uniswap. That's like, they are in a jurisdiction that they can't get access to Binance or Coinbase, or like Coinbase US or something like that. It is a really interesting question. Like if we're going to see tax nexus law catch up with the totally decentralized world that we live in now. Joe, you have any thoughts on that? It's not exactly your world, but
yeah, it's really not my world. I even, when I typed the response, I said disclaimer, I'm not an international tax pro, so I'm gonna
totally demure on it.
Yeah.
What we see is people tend to line up their tax nexuses with their organizational structure. With the one copy. So if you have a US C Corp and a Cayman Corp and a London Corp, like that's how you're lining up your tax nexuses. With the one caveat there, of course, being that if you have US based people, the IRS is very interested in your operations no matter what. So like this is getting away from like tax nexus law, because I'm not an international tax lawyer either, way outside my pay range. But we do know that like what we have seen is, the IRS does follow people that are US citizens that are doing work in the business. Even if you have a Cayman entity, the IRS certainly seems to be taking the stance that you have a US tax nexus if you're headquartered or predominantly managed by people in the US. So that's the only thing I ever tell people to be careful of, is like it's all fun and games until the IRS decides to take a real close look at you. So that's the tough one. Oh, NFT. You want to, Joe? This is your specialty, buddy.
Hold on, what's this question? Let me read it.
Is that NFT an intangible asset for, especially for impairment purposes?
I say yes. And again, we could go down the rabbit hole with this, why I don't think it's considered a collectible or anything else. So yeah, I would typically consider it in the same bucket. The problem is the pricing. How do you price it, right? You know, a non-fungible token is literally non-fungible, so they're not all the same, meaning there are not, you know, easily accepted, you know, published prices. So you can talk to a lot of different accountants and they'll all give you different answers. I think my personal opinion is probably using some combination of previous recorded sales from the same collection, probably stratified in some way to correlate to rarity properties, something like that, using historical sales data. So that was a mouthful, but yeah.
We'll have some over the next like few months. We're going to have some stuff coming out around this, just a little sneak peek. You know, at the end of the day, you're always going to be doing a valuation exercise for this kind of data. I like to imagine a world. I know this is like the corny shit, but like I like to imagine a world where like you hire like some like, you know, 23-year-old wearing a trucker hat, smoking a blunt to come in and like look at your NFT collection once a year and like make recommendations on pricing and markdowns and all that kind of stuff. But I think that that's actually very reasonable, that there will be services. There will be, you know, basically in the same way that you have appraisers or you go to Antiques Roadshow. Actually, that's a show I want to watch, the NFT Roadshow. There will be people who do this for a living to kind of make the evaluations on these, and then you'll use that to do your impairment process or your mark-to-market process, whatever you end up running for it. So I think that's where we're going to end up, is some sort of independent person making assessments. Guys, this has been phenomenal. This has been super fun. Absolutely my favorite part of every month. Thank you guys so much. If anyone has any questions, please email us info@bitwave.io. You can email us info@bitwave.io. Best way to get a hold of us. We'd love to help you out with anything. As always, have a wonderful time. Hey, do we have we already have the next one. We have another webinar coming up next month. We'll send out information about that. We also have a new thing that we're going to be doing, which we'll send out information about, which is a release. We're going to be doing a release webinar. So for any of our customers that are on the call, you'll get invited to learn about our, basically we're moving to a more structured release cadence where you can learn about, you know, the Bitwave summer release, and we'll have information about what was included in that. We'll do training, all that kind of stuff. That's going to be coming up in August here. So thank you so much, everybody. Joe, Ore, thank you so much, you guys. Have an absolutely wonderful day, and take care.